I'm actually now doing an illustration from unit 1, all right? Although it's actually relevant to the topic that we're discussing, this illustration is placed in unit 1, and I feel this is the best place to actually cover it. Silver Limited issued irredeemable preference shares with a face value of rupees 10 each and a premium of rupees 90, which means the total proceeds that Silver Limited would have received would be rupees 100. All right, so Silver Limited actually issued preference shares and it received rupees 100 per each preference share. These shares carry a dividend of 8% per annum. However, dividend is paid only when Silver Limited declares dividend on equity shares. The question is analyze the nature of the instrument. The two characteristics that we have to see is with regards to one, redemption, and the second is with regards to payment of dividend. Does Silver Limited over here have an obligation to pay cash with respect to the redemption? The answer is no. There is no stated maturity date. All right. So Silver Limited does not have an obligation to pay cash to the shareholders. It does not have an obligation to repay this rupees 100 that it received. It does not have an obligation to pay this 100 rupees back on any particular date. It is at its discretion. Silver Limited, these preference shares are irredeemable, which means whenever Silver Limited wants to, it can actually buy back these preference shares. If it does not buy back, the preference shareholders will receive money only upon liquidation. Upon liquidation, all the assets will be sold, and then preference shareholders will be given their money back. All right. So does Silver Limited have a specific contractual obligation to return this rupees 100? The answer is no. It is at its discretion. The second characteristic is with regards to payment of dividend. All right, these shares carry a dividend of 8%, but the question is mentioned that this dividend will be paid only when dividend on equity shares is paid. Now you know that dividend on equity shares is a discretion that Silver Limited has. All right, if in any particular year Silver Limited's performance is not great, then it has a discretion to not declare any dividend on equity shares. If it does not declare any dividend on the equity shares, it will also not declare any dividend, or it will also not pay any dividend on these preference shares as well. All right. So with regards to payment of dividend also, Silver Limited has a discretion. If it wants to, it can pay. Otherwise, it can choose not to pay. All right. So there is no obligation to pay cash with regards to dividend as well. So one, it does not have an obligation to repay the face value of the principal amount on any stated date, and two, it does not have an obligation to pay dividend either. All right. So in both the cases, this actually is in the nature of equity. All right. In both the cases, it does not have any obligation to pay cash. Therefore, the amount that it receives, the 100 rupees that it receives, will actually be credited. It will be bank account debit 100, and the credit will actually go to shareholders' funds or equity. All right. We are not going to record this as a liability. The reason why we are not going to record this as a liability is because the company has a discretion with regards to payment of cash. If it does not want to pay cash, it need not pay it. All right. So that is a characteristic of equity, and therefore it will be shown as part of shareholders' funds right from the day one. From the date of issuance, it will be shown as part of shareholders' funds. The question is, let us say we are showing this as equity. In a subsequent year, the company has paid this dividend of 8%. The company has actually, let's say, paid this dividend of 8%. Will this dividend be shown as an expense in the P&L? Like in the previous illustration 1 of the unit 3 chapter, we said that the dividend will actually be recorded as an interest expense. Over here, will the dividend actually be recorded as an interest expense in P&L? The answer is no, because the instrument is actually equity in nature. Payment of dividend will be debited to reserves and surplus. Just like how payment of dividend on equity shares is debited to reserves and surplus, over here also payment of dividend on preference shares that are classified as equity, payment of dividend on preference shares that are classified as equity will be debited to the reserves and surplus. It will be debited to equity only when and whenever it is paid. If there is no payment, obviously no journal entry is required, but whenever it is paid, it will be debited to equity. All right. So let us say in the first year, dividend of 8% is paid. The dividend will amount to 0.8. Remember, the 8% will be calculated on the face value of 10. So the dividend will be zero point 0.8. In that year, the journal entry will be equity or reserves and surplus debit of zero point 0.8, and we will credit a cash of zero point 0.8. All right, so that will be the journal entry on payment of dividend. All right, so this was with regards to illustration number 6 of unit 1. I felt this is the right place where it's probably supposed to be discussed, and hence I've picked it up for discussion with along with Unit 3 chapter. All right.